High Mount Research. Good afternoon, everybody. Willie here. Welcome to our town hall meeting under new ownership, new management, High Mount Research. Glad to have you on board. In the past, we have done these on a weekly basis. Probably not going to do it quite on a weekly basis going forward. Still trying to figure out the exact schedule of that, at least monthly. These early month updates I think are very important. Probably every couple weeks we'll have these sorts of conversations. Over time, hope to include some sort of interactive component to it, so it's not just me talking and showing you charts, but have the ability to actually have a conversation, hear your questions, respond to your questions, that sort of thing. So that's the plan going forward. Right now, it's listening to me talk, look at some charts that I have to share with you. And with that, let's get into it. Have a couple of things to talk about today for today's discussion. Talk about the market, range bound with a bias lower. Look at the price action, look at what's happening from a breadth perspective to reach that conclusion. Fed meeting yesterday, so talk about the Fed seeing higher rates, and the market is still looking lower, not believing that the Fed is going to stick to its guns. From a sentiment perspective, more evidence that optimism is waning. But if we look at it from a longer term perspective, households still have very elevated exposure to equities. So not fitting with this idea of rampant pessimism that is being put out there. It's a challenging trend environment, and that is not bull market behavior. Go through some of the trend indicators there. Commodities, this is not actionable right now, except to the extent that we want to keep them in the conversation. I think too often we drop something out of a portfolio and say, okay, now's not the time for that. We lose track of it. I think from a long-term perspective, having commodities as part of that conversation, even when it's not in the actual portfolio, makes a lot of sense. Portfolio positioning, made some changes to our tactical opportunity portfolio, following relative strength in GLD, so that's gold and SMH semiconductors. It's really not a matter of what we like or what we don't like. It's a matter of listening to the market in terms of relative leadership. Once we've identified sort of the risk profile we want to take, then we can sort by relative strength and lean into the leading areas, and then zoom out and think about some of the secular trends and realize that they don't resolve. They're not going to resolve all in one week. And so a little bit of patience, making sure that that trend is still intact, but not demanding resolution on a short time frame. Some of these things took years to build. It'll take years to unwind, or years for the next trend to emerge as well. And through this all, making sure that we're not getting stuck in our narratives, but we're actually listening to the message of the market. So range bound with a bias lower. What do I mean by that? Top here, we've got the S&P 500 within the summer highs and lows, within still the December highs and lows, looking to see resolution there. But when we drop down and look at from a breadth perspective, here we're looking at new highs, less new lows for the NYC plus NASDAQ. We've been in a condition now where we've had more new lows than new highs. That's what we saw most of last year. That suggests that the bias is lower. Remember, over time, the gains in the S&P 500 accumulate when you consistently and persistently see more stocks making new highs than new lows. That's not what we have right now. We can look at the same thing from the perspective of the NASDAQ. Here, we've got the NASDAQ on top. A very simplistic approach here. If we're seeing more new highs and new lows, that's a smiley face, call it green. More new lows and new highs, that's a frowny face, call it red. Again, whether we're looking at it from an NYC plus NASDAQ perspective or looking at it just from the perspective of the NASDAQ, still more new lows than new highs. That's what we saw pretty much all of last year. That the NASDAQ, S&P 500 came under pressure, go back off of those COVID lows into November of 2021, consistently and persistently saw more new highs and new lows on the NASDAQ. These sorts of breadth indicators matter. Yeah, it's great to talk about the NASDAQ being up 7% or whatever it is over the past month, up double digits since the beginning of the year. That's great. But in terms of sustainability, the breadth data argues against that. And you zoom out and it looks more like volatility from an index perspective than it does sustainable strength. So I'd feel much better about this environment if we were seeing more stocks making new highs, new lows. Haven't seen that in a number of days, a couple weeks now, was the last time we saw more stocks making new highs than new lows. And we're also seeing it from a volume perspective, starting to see more downside volume. Yesterday stopped just shy of the 9-to-1 threshold that we watch. It was 8-to-7 downside volume. And we had that 15-to-1 downside day earlier this month. So we're starting to see more evidence of downside volume pressure. Add to that the more new lows and new highs. And really, it's this picture of these tactical tailwinds that we had coming into this year really starting to dissipate at this point. So then turning gears and think about the message from the Fed and the disagreement between what the Fed is saying and what the market is looking at. Top here, we've got the two-year yield, and we've got the Fed funds rate. There's about a percentage point difference between where the Fed funds rate is after yesterday's increase and where the two-year yield is after yesterday's decrease. That 94 basis point spread, it's the widest spread between the 2-year and the Fed funds, most negative. So the 2-year yield is the most below the Fed funds rate that's been in over a decade. But at that point and these previous points in which we saw these big negative spreads, that the Fed was already cutting rates at that point. You have to go back to the early 80s to get to a point where we had this huge negative spread and the Fed was still raising rates. So really this argument right now between the market and the Fed in terms of the direction of rates, and I don't think we can show much more clearly than when we look at what the futures are pricing in for the end of year rates and what the Fed is pricing in for end of year rates. So the orange that's the dot plot updated as of yesterday. So 56% of the dots were at 5%. So another 25 basis point rate hike from here from the Fed's perspective as being appropriate. And the tail is is higher beyond that. In terms of what the market's pricing in, it's pricing in about a 4% Fed funds rate at the end of the year. The area that gets the most responses from the highest weighting from the market is this 4% level. So and then right here, that's where we are after yesterday. And so the Fed's saying we got to look higher for rates from here. The market's saying, no, we got to look lower for rates from here. Really looking in two different directions at this point. How the Fed resolve, or how the market gets back in line with the Fed, or how the Fed gets back in line with the market remains to be seen. But this is a divergence that we want to pay attention to and see how it resolves. My guess is if the Fed sticks to its guns, then that means yields and spreads likely need to move higher from here, that the market gets on board with what the Fed has said. And to some extent, you can understand that reasoning. We went through at least a mini bank crisis over the past couple of weeks, and the Fed stuck to its guns. That dot plot for March was actually a little bit higher than it was for December. So not seeing this evidence of kind of the Fed pivoting at this point. And why is the Fed sticking to this? In large part because inflation remains elevated. Median CPI just hit a new high, the 3-month change continuing, starting to reaccelerate as well. So there's price pressure still. The Fed, I think, has decided that it can kind of manage the banking side of it, add liquidity where needed, be the lender of last resort as needed, and still at the same time continue to fight inflation, continue to raise interest rates, continue even with quantitative tightening as it goes forward. So unprecedented times for sure. But at this point, the Fed is kind of pushing on its view that it's not going to be cutting rates, that it doesn't have the flexibility to cut rates because inflation pressures remain elevated. How this resolves itself from a macro perspective, I think looking at our macro health status report is helpful in this regard. Updated this earlier this week where you got 3 green lights, 3 red lights, where things could change if we start to see stresses, if the bond market starts to come in line with what the message of the Fed, then corporate bond yields likely move higher and that momentum trend starts to turn higher. That would change this negative. The yield curve is already inverted. That's negative already. If we start to see more stress, and there is evidence of that already, that if this financial stress index gets above 0, that turns red. And then if the earnings momentum trend that we've talked a lot about, especially mid cap earnings momentum trend, very strong still, given the environment we're in, trend is still rising, pretty impressive resiliency there. So if we start to lose some of those areas, that is to me a sign that these macro issues are starting to filter into the market, and probably go back to where we began, that range bound with a bias lower. That bias lower starts to be realized, challenging those December lows for the S&P, and then ultimately probably the June or October lows. I think it's fair to assume some test of that at this point, especially given the behavior we've seen in the market, in the past couple weeks. And the reaction on the part of investors, I think, tells a key story as well. And yeah, there's a lot of talk. Well, investors are pessimistic. We're seeing extreme pessimism, sentiments washed out on a very short-term basis, perhaps. But we've been making the case and continue to make the case that at this point in the cycle, we need bulls to have a bull market. We need to see optimism build. We don't need to see a break below those December lows, whether we're looking at the NAIM exposure index, so active investment managers or advisory services polled by the investors intelligence data, or the much maligned individual investors in the AAII sentiment survey. If though any of those, all of those break below those December lows, that is to me a sign that we're not building higher, but we've really exhausted that. And we need to kind of have a full reset from a sentiment perspective. And that probably means price and sentiment retesting last year's lows. Not seeing it yet. The bull bear spread was for the AI slightly narrower this week for, in favor of bulls this week. II is slightly towards bears this week. Slight increase in the exposure index. Nothing, no big moves from a sentiment perspective this week. Over the last couple of weeks, the shift away from optimism, not very encouraging. Then when we zoom out, and I think this is a important thing to pay attention to, because this is long-term data. This is put together by the Fed. This is household asset allocation data. Is similar to what the AAI puts out on a monthly basis. It's asset allocation survey that gets, well, it's self-reported. Who knows if they actually are keeping track of the right things? And the sample is people still buying mutual funds. There's lots of naysayers about the AAI data. My point with bringing this up is this data from the Fed. So this is numbers. This isn't surveys. This is the actual numbers that they put together, matches what the AI survey data says, which is households have way above exposure to equity, average exposure to equities. And even last year, as we talked about all this pessimism, didn't really bring that equity exposure down very much. Cash and bond exposure remains relatively light. So there's heavy exposure to stocks, not much exposure to cash and to bonds. What the Fed data is supporting the survey data from the AII. So I think that should add some credibility to the AII data, and also just draw the picture that households have a lot of equity exposure right now. They've not reached a point of maximum pessimism. Why does this matter? Well, if we look at the correlation between kind of the stock bond ratio, so the equity exposure divided by the bond exposure, compare that to forward returns for the S&P 500. And we've got the forward returns for the S&P 500 inverted here. So when the blue line, when the orange line, goes higher, those are forward returns moving lower. there's an 88% correlation between the stock bond ratio and forward returns. So the higher the stock bond ratio, the lower the forward returns. The lower the stock bond ratio, the higher the forward returns. And we're just coming off of record highs in terms of the stock bond ratio. So when we look forward, expectations for equity market returns should be fairly muted. So staying in pat and saying, well, what worked for the past decade is going to work again in the next decade, probably not going to happen, because a decade ago, we were at a relatively low level of equity exposure relative to bond exposure. There's quite a difference now versus a decade ago in terms of household equity exposure and household asset allocation. And that suggests going forward, the experience of the market is likely to be quite a bit different. From a market perspective, so think about the trends in the market here. This is weekly data, new highs versus new lows. Just to draw the picture here, that we had this period of more new lows and new highs. That's consistent with previous bear markets that we've seen over the past decade or so. Earlier this year, started to see more new highs, new lows. That's encouraging. Saw that improved price performance. What we've seen over the past couple of weeks is somewhat unprecedented in the data, and we could stretch it back further, and still it would be unprecedented to see this period, this extended period of more new lows and new highs, that comes to an end, and then quickly reverts back to more new lows and new highs. So yes, it's a unique environment, but when we look at it from a broader perspective, it's, even though it's unique, it's not an environment that we would expect consistent strength to emerge, because in some ways it matters more. In many ways, it matters more that we're seeing more new lows and new highs right now than that we were seeing more new highs and new lows, or last year we saw more new lows and new highs. As long as we're seeing more new lows and new highs, that's a risk off signal to me. We look at it from a sector perspective, a couple of different things to dial in here. One, from a long-term trend perspective, S&P trend is lower. All of the sectors have long-term trends now that are lower. Energy and industrials had been trending higher. Energy for quite a while. Industrials trying to find some footing. Those trends have turned lower. So from a sector perspective, there's not really much of a place to hide from a long-term perspective. In terms of trends rising, so the direction of the 200-day average, here we're more interested in the S&P 500 than the individual sectors. So the S&P 500 trend falling, that typically not what you see when the market's moving higher. From a sector perspective, what matters is whether the sectors are above or below the 200-day average. We've got 3 sectors above their 200-day averages. That's not consistent, kind of with from our fear or strength perspective. It's neither strong nor evidence of fear. And so it's kind of the muddling middle ground, not an environment where the S&P tends to move higher. From just an individual sector perspective, if we're going to get long sectors, we want to make sure we're above the December lows and the June lows to begin with. Prefer to be above also the December highs. Tech is fitting that, and communications services fitting that. So from a tactical perspective, that's a place to look. But remember, long term is not really a favorable trend backdrop at this point. And then just to touch on energy, that was a safe harbor, relatively speaking, for U.S. equities last year. Not the case now this year. Trends there have really started to falter. So when we then zoom back up, look at the bull market behavior checklist, no across the board for all of these. Long-term trends are falling in the US and around the world. 200-day moving average is falling again. This morning I saw it's about 12% of global markets above their 50-day averages, still not great. And then the breadth data is still moving lower. So not behaving like a bull market. The various ways we can add it up and look at it, not behaving like a bull market. And another way it's not behaving like the bull market is the volatility we're seeing. Bull markets tend to be quiet, tend not to have these big day-to-day or week-to-week swings. Coming off of those COVID lows, you had multiple weeks where the index didn't move, uh, 1% or more on a daily basis. Um, where there were 0 days with a 1% swing on the S&P 500. You know, now in the bear market that we've been in, we've only had one instance. That was back in November. Otherwise, you had these day-to-day swings. That's not characteristic of bull markets. Bull markets see steady progress. Bear markets see big swings. From a long-term trend perspective, uh, just showed this earlier this week, just something to keep in mind as we go forward. Bonds are still in a downtrend, stocks are in a downtrend, commodities are in a downtrend. Really, this is a less and more environment from a long-term trend perspective. In terms of what should happen next from a business cycle perspective, bonds, the bond trend should turn higher. They should lead the way. But if we've got the Fed still raising rates, it's hard to see bonds, which have already rallied quite a bit in response to the kind of the banking news of the past couple of weeks. Hard to see that trend emerging at this point with the Fed still raising rates. And here I want to talk, kind of put bonds to the side and look at the relationship between stocks and commodities. And because I think this is a great behavioral lesson that we need to think about. So we're 4 or 5 weeks into this new uptrend in stocks versus commodities, after 107 weeks of commodities out the trend favoring commodities over stocks. That was the longest trend since the 70s, and emerged after this period where I think it was like 90 some percent of the time stocks were in an uptrend relative to commodities over the previous decade. So not a period where people were thinking about commodities. And unfortunately, when people weren't putting commodities to work in their portfolios, they forgot about commodities, took them not just out of the portfolio, but out of the conversation. And that is to their detriment. There's a model I put together that if we rotate from stocks to commodities, depending on the direction of that trend, that relative trend, as we're switching back and forth between them, we reduce the risk in our equity portfolio and increase the returns in our equity portfolio. So commodities don't always need to be part of a portfolio, but there are times when it makes sense to, and we're not going to know what those times are if we forget about commodities, if we shove them to the side, let them fall onto the floor, keep them on the table, keep commodities in the conversation, even when they're not part of the portfolio. That I think from a go forward perspective in terms of how to think about asset allocation, that's one of the most important things I think we can do as asset allocators, is not forget about the things that should be on the table but aren't necessarily in our portfolios at any given time. So commodity exposure right now, no, the models don't call for it, but we do want to keep them part of the conversation so that we know if and when we need to lean into commodities again. This is a table of the tactical portfolio that we made some changes to this week. We added semiconductors, 5.1 position there, and sold home builders. Gold, we added an 8% position there, sold the exposure we had to metals and mining. And then also we had exposure to insurance, and we sold that, increased our cash allocation. So we'll go into semiconductors and gold in just a moment. But from a tactical perspective, continuing to raise some cash. Like I said, those tactical tailwinds that we had at the beginning of the year, no longer there. From a equity exposure perspective, foreign exposure over domestic exposure right now. The only commodity exposure we have is to GLD. Doesn't really behave like the CRB, and we'll get into that actually in just a moment. Why choose these? Well, we've got a relative strength matrix that we use, a ranking system. Here it's our ETF universe. I think it's almost 300 ETFs that we've sorted first by size and by trading volume and by how long they've been around, and don't want to have anything with leverage there. And so then we rank those and sort them, and what you see coming through near the top, lots of gold exposure, lots of tech exposure, especially semiconductor exposure. So as we're thinking about rotating in and rotating out, this is almost beyond a decision about kind of stock bonds, cash exposure. This is about, given that we have some, want to have some equity exposure, where are we looking to have that equity exposure? And so semiconductors, don't need to like them, don't need to love them. We need to respect that they're at the top of the relative strength rankings. Uh, Gold, the reason to like gold is the long-term trend there is rising. It's one of the few areas in the world where we actually have a rising long-term trend. It's been a little bit volatile over the past few weeks. There's an uptrend, then a couple weeks of downtrend, now a couple weeks of uptrend. A little whipsaw, but the trend now is higher. And if we need to allocate capital, and portfolios always have to be 100% allocated to something, um, leaning into something that isn't a long-term uptrend makes some sense. It's also at the top of the relative strength rankings. And then this, pulled this off of Koifin. This is SMH, Semiconductor ETF. Similar sort of story, is looking for things in uptrends, not just relative strength, but seeing a pattern of a higher low, higher high, higher low, now breaking out higher high, looking pretty good on an absolute basis, turning higher on a relative basis as well. So leaning into that strength. Semiconductors, I don't tend to be a technology bull. Started in the industry in 1999, right near the top, end of 99, so near the top of the NASDAQ. But respecting strength where we see it, and putting those emotions aside is kind of what we need to do in this environment. Setting aside the ETF portfolios and just kind of this composite asset allocation model, breaking it down in US exposure, global exposure, and then bond and commodity exposure. Areas of focus right now: bonds. Bonds are in a downtrend, so keeping this shorter maturity bonds, I think, makes sense. If we go back to our ETF rankings, lots of short duration bonds are near the top in there with gold, with semiconductors. About the only area that has a rising long-term trend, that's Europe ex UK. A little bit of overexposure to large cap value, and then the mid cap areas, not as much as what we saw a couple weeks ago prior to the banks imploding. Lots of regional bank exposure in the mid cap indexes, also in the small cap indexes. So where we heavily underweighted: Canada, commodities. Look at this current column. That's kind of break this into 100% and where we would have exposure based on this composite allocation model. If we don't want to get into sectors, if we don't want to get into sub areas, we can keep it kind of high level and use these as exposures from a portfolio perspective. Talking about secular trends, this is a US versus the rest of the world. You can see this long period of US leadership starting to come to an end. So go over the past decade plus, you had extended periods of US strength, only modest periods of strength from the rest of the world. We're now at 15 weeks of the rest of the world doing better than the US from a trend perspective. We haven't exceeded the longest trend that we've had in the past decade, but it's still going. So it suggests that we've seen a shift in trend. And if your history is limited to just the past decade or so, it seems unprecedented. Go back the prior decade, and seeing strength from the rest of the world was not exciting, was not the exception. It was more the rule. And so I think just broadening our perspective is useful to understand when some of these longer term trends change, whether we're talking about within the US or around the world in terms of global equity exposure. In the same way that we have kind of the detailed ETF universe relative strength rankings, we also have our macro ETF relative strength rankings, similar to what we were looking at from that allocation model. Here we're pairing it with ETFs, and rather than just rather than looking at a blend of relative trends and absolute trends, here we're just looking at relative strength. We have some trend indicators in here for reference, but they don't factor into our relative strength work. the top of the relative strength work right now. We've got gold, we've got cash, we've got short-term treasuries, we've got Japan, surprisingly, and Europe ex UK. At the bottom, small caps, Canada, emerging markets. Mid caps are deteriorating. Talked about the influence of banks on them. Pacific ex Japan also deteriorating. Improving, bonds are improving. Large cap growth, that's the technology play there as well. So we'll try to keep this updated as we go forward. And if I haven't updated it and you would like to know what it looks like, reach out to me, and I'm more than happy to share it with you. I'm updating it on a weekly basis if I'm not always sharing it on a weekly basis. And that's a general rule for any of the things that I've discussed here. I've probably updated them. I just haven't shared them necessarily. So if you want to keep track of something, ping me, ask me for it, and I'm will probably be happy to share it as I update it, as long as you remind me to share it with you. So we'll leave it there. If you've got questions, reach out to me. You know how to get a hold of me. And we'll do this at some point again, probably the next couple weeks after we get through the end of March. Get the weight of the evidence updated, take a look at where we finished this month and what's in store for next month. So thanks for listening. Thanks for being on board. Hope to hear from you and talk with you in the coming days. Have a good week, everybody.